Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at a viewer requested company. So if you have any stocks that you're wondering and you want me to check it out, do me a favor and put it in the comments, and I'll definitely take a look at it and possibly even put it on a video. So some of the key highlights about this company is 26% undervalued. It has beaten the S&P 500 the past 5 years, 35 years dividend streak without a reduction, dividend growth of 10% the last 5 years, and hedge funds have increased their holdings last quarter. So if you want to take a look at this stock and maybe this is something you're looking at, sit back, enjoy. Please remember that it's not financial advice. I'm not a financial advisor. With that said, let's take a look at this company. So the company is McCormick. The ticker symbol is MKC. If you're not familiar about this company, it is a company that manufactures, markets, and distributes spices, seasonal mixes, and condiments. So you most likely have their products in your house. So they do a lot of spices, as you can see, and grinders, as well as recipe mixes, Instant Pot, chili, Mexican. Definitely take a look at it. It is a very interesting company. I think it's a company that everybody uses. So one of the things that I found is an article at Motley Fool by Cody, October 21, 2020. So some of the key points about this article: consumer staples, the earnings has been mixed, but the company has nearly 40 years of consecutive years of dividend growth streak under its belt. The stock is somewhat discounted at the current valuation. So if you get a chance to read this article, talks a lot about some of the good things about this company. It's a tremendous brand power, and it's one of the things that I also saw in this company is a decent entry point. So they think that at this point it is a decent entry point to possibly add to your portfolio if you are looking for a stock that fits in your category. So let's take a look at Simply Safe Dividend. Based on their dividend safety score, they're rated at 80, which is safe. The dividend yield is 2.0. It is a large cap, and then you can see the beta is low. Looking at the key metrics, payout ratio is 55, forward payout ratio is 52. You can see during the recession they have increased their dividends from 07 and 09. Dividend growth streak of 35 years without a reduction. You look at the dividend growth, last 20 years 10%, last 5 years 10%, and then the latest is 8%. So 35 years without a reduction, 35 years consecutive increases. Payment details: you get paid quarterly in the months of January, April, July, and October, and your annual payout is $1.48, which breaks down to about 37 cents per quarter, per the months. And then you got your dividend yield over here. 52-week range, you can see it is close to the low of 71. The high is 104. So pretty good time to possibly buy it, in my opinion. You can see some of the key metrics in here. Return on investment capital 9%, and then return on equity is 15%. Now if we go to tip ranks, their rating is moderate sell, which is one hold and one sell. Price target is at 74, with the high price target of 82, and then 74, and 67 is the low. Now if you go to the stock analysis, you can see Smart Score is on the 6, and you can see insider transactions, they've sold their shares. Hedge funds have increased their holdings, as you can see, and then it's a positive confidence signal. Increased their holdings last quarter. Now if we go to CNN Business, based on their forecast, they rated as a high of 96, medium 79, the low is 66, and then their rating is mostly a hold, 8 holds, 1 buy, 2 outperform, and 2 sells. Now switching along to NASDAQ, based on their analysis, there's about 9 of them. They rated also as a hold. And here are like JP Morgan, Barclays, and then their analysis, you can see in the high of 87, average of 77, and the low of 67. Now if we go to Yahoo Finance, looking at who are the top institutional holders, you can see Vanguard, BlackRock, State Farm, and then you got, State Street and all these other guys, Morgan Stanley. Now if we go to some of the financials, you can see profitability, profit margin. You can see right here operating margin. You can see the income. You can see the balance sheet. You can see the total debt is 5 billion. Current ratio, book value per share 17, and then you can see the operating cash flow. Now if we swing to, again, sticking at Yahoo Finance, you can see 5 years pretty much have been beaten in the S&P 500, only about like this part right here. So pretty good performance. Now looking at the 10-year performance, you can see 140% for the 10 years. Now if we swing to stock card, so one of the things I'm looking at is the financial strength. So you can see right here, based on 6 analysis, they rated as a good for the revenue. Profitability based on 22, they most of them is either good or neutral. So the cost, struggling with management costs, it's a mixture between neutral and bad based on 12 analysis. And then the margins, you can see free cash flow, mostly 3 bad, 2 good. Cash and debt, you can see neutral right here. Financial resistance ratio, and then management effectiveness. Now if we go to Stock Rover, based on their analysis, they also rated as a hold. 8 of them said it, so it's about 6 hold, 1 sell, and 1 strong sell. Now if we go to the visuals and look at the industry risk and return, S&P 500 for the 5-year return is 58, and then MKC is about 62, so it's slightly beating it, not as much as I would like, but you can see the 3-year return, S&P 500 was performing well. Now if we swing to simply Wall Street, and you can see some of the positives and negatives. So share price versus fair value, they rated as 100. Currently it's at 73, which is 26% undervalued. And then you can see other stuff in here. So my take with this one, I think it's a solid stock to own. I think it is a, my opinion, great time to enter if this is something that has been on your watch list. For me, I rather, in my opinion, and this is just me, if I'm going to go in that kind of stock, I would rather go with the Hormel. Simply because I am a big fan of the product. I'm from Hawaii, so you can see Spam is something that I am very familiar with, and I love the product. So I always say you choose the stocks that you're familiar with, and then you have you're a consumer of it. So it's a good product. MKC is a good product. It's a solid company to own, I think, in times of recession. So you won't, it'll be a solid stock in your company, in your portfolio, in my opinion. But also do your research, guys. So always make sure you do your research. And that's about it, man. Thank you so much for watching. Hope you like and subscribe if you haven't done so. Stay cool, guys. Keep investing, and I'll catch you guys in the next video, right? Take care. Aloha. Bye.